Hi there, and welcome to another edition of the Premier Investments in Wealth Management Financial Program. My name is Doug Wagner. I'm your host, and I'll introduce you to the other three gentlemen at the table with me. But before we do that, what I'd like to do is invite you to use your phone, your tablet, or maybe even your lap or desktop, and open up your favorite browser, go to premieriwm.com, click Get Started, and then just answer a few questions. Do you know if you're ready for retirement? Well, if you're like most people, you probably don't, but you can get ready for retirement. It's just as quick as that. They'll provide for you at Premier Investments in Wealth Management a one-page Premier Vision document and an opportunity to sit down with one of their professional wealth advisors. No obligation, no fee necessary for that first meeting. Just go to premieriwm.com, click Get Started, and answer those questions. It's important that you're ready for retirement now, maybe more than ever. And it doesn't matter whether you're 35 or 55, or maybe you're looking at distribution time and you're 65. You need to have professionals who are with you that can help you make sure that you're getting things done the way that you need to and the way that you want to so that you can live the life you deserve. PremierIWM.com. for Premier Investments in Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. 800-383-6590 if you want to make that phone call and make an appointment. Introducing in the middle of the pack is a wealth advisor with over 30 years of experience in the investment industry, Jonas Everett. How are you doing?
Great, Doug. How are you, sir?
Doing well. Thanks very much. Good to see you again. Another show with Dr. Casey Mushrush. He's a wealth advisor and accredited investment fiduciary, certified financial planner professional with over 10 years of experience in the investment industry and one of the biggest growing families you're going to find. Casey, good to see you again.
Well, you must have seen us out on a walk with our cat again here recently, then. That's what that sounds like.
The walking cat. That is awesome.
What do you have, 5?
5 kids. 2 kids.
You had a basketball team.
Yeah, exactly. He's working on the baseball team.
Well, I was going to say, you're only a couple short of an infield.
Yeah. The other voice you heard.
I've done in 3 years. I know you.
President of Wealth
You got to
Advisor.
have goals, Roger. I mean, this is the...
I haven't seen any doctor's appointments on the calendar. So once I see doctor's appointment, Eric, I know, hey, we got another bun in the oven. We're growing the Premier family here.
That's Roger Abel. He's president of Wealth Advisor, Premier Investments in Wealth Management, an accredited investment fiduciary as well, with over 22 years of experience in the investment industry. He is the big kahuna, Roger Abel.
I love the intro gets different every
I was
time.
going to say, I don't know that I've seen that one yet.
Well,
The Jaws 50th
Well, I thought it was
anniversary.
the Jaws.
Exactly, I know.
Way to go, Doug. That was great.
Oh, my goodness. PremierIWM.com is the website. You can download their guide they have. It's called Navigating the Road to Financial Freedom. Really cool website. They have lots of downloadable and really, really good stuff out there. So us in here, me and Jonas are probably the oldest. We're in our 50s. The other two here are significantly younger than we are.
Probably.
Well,
I mean,
we are the only ones. in our 50s.
discretionary. Like,
That's how math works.
Probably.
It's so funny because the more information we get, it seems like the more information we get, the more sort of tech savvy and media savvy we become. Would you agree or disagree, Roger Abel, that people who are younger are more interested in investing than they have been at any time in the past?
100%.
Okay.
I think there's 2 reasons for it. I don't even know if this is in the outline, but I do believe young people are more interested. I think, one, the younger generation, let's say under 30, when I say younger, under 30, their parents have taught them the value of investing, meaning they've taught them you need to do a Roth IRA, you need to max your 401k out, you have to save money if you're going to retire. Unfortunately, for most of the people that are under 30, their parents had nobody to teach them because their grandparents had a pension. And what's likely happening is we have this generation of people that are woefully underprepared for retirement, and they're trying to teach their kids, please don't make the same mistake that I did, start early. So that's one.
Yeah.
They're being guided.
Okay.
We use the term Roth IRA. We throw this around like it's been around forever. It's been around since the late 90s. So unless you were an earlier adopter and saw the value in this, you probably waited 10 years before you did anything. Okay. So one, they're being coached. But two, I think COVID changed the game for a lot of people
Okay.
because they were at home. They didn't have anything to do. Gambling everywhere was shut down. So guess what the stock market became? Their entertainment. They thought it was okay to day trade. And whether that's healthy or profitable or not, that's up for debate. But what it did, to your point, it got an entire faction of people interested in investing. I would have parents call me up, hey, my son or daughter, they want to buy this stock. What do you think? I said, if they're willing to light it on fire, sure, whatever they want to do. I said, what's the worst case scenario? They lose it all at 17. They have a lifetime to get back into it, but it's going to be a learning lesson.
Right.
I almost equate it to this. Right now in college athletics, it's all about the NIL money. We'd agree, right? Everything is about NIL. And somebody told me, they're like, man, this is so bad for these kids. Just get all this money when you're 18. And I said, I actually don't think so. I think it's a super, super positive. Because one of two things are going to happen. One, they're going to set themselves up for life, which they never could have done before.
Right.
Right? You're a top 100 basketball high school player in the country. You're getting $1 million. Like you have the opportunity to set yourself up forever.
Right.
Or you're going to get $1 million or a few million or whatever it is, and you're going to blow it all. That's not a bad thing. You learned a really valuable lesson at 17, 18, and 19 versus 30, 35, and 40 when it really counts.
Yep.
It's interesting.
Well, that actually goes to something that I talk to people in the estate planning context constantly. I would much rather have a kid make a $10,000 mistake than have him make $1 million mistake.
Well, you know,
And it's exactly that same.
I don't know if you use this with your people, but I have the 3B mentality, like with money. When people get money at a young age, they typically blow it. So we talk, like I talk with people about in their estate planning, giving money to their kids in 3 phases because it's called the 3Bs. And the first B is typically if you come into money at a young age, you're going to blow it. If I would have got money when I was 19 years old, I'd have had the best boat money could buy. That's what I like to do. I would have blown it. There's 1,000% chance. Well, when you give them the second tranche of money, most people feel really bad for blowing it. They learn their lesson. So they're like, man, what do I do to make up for the money that I blew? And they think that the best thing to do is to start a business, right? They see business owners, highly successful. Well, unfortunately, 90% of small businesses are out of business in 3 years. So they lost the second third. By the time they get the third B or the third of the money, they've blown it. They had a bad business deal. They'll take the last third and they'll bury it. They won't spend it. They're like, I'm not going to make mistake 1 or mistake 2.
Yeah.
And I think that's something that's overlooked. And I think you were alluding to, Casey, that, if you give people money in phases of life, it's much better than giving it all to them at one time. And the last third, if anybody wants my opinion, should go to your kids at 53. When they're 53. You want to know why?
Why?
There's math behind them. That's my estate.
Just like
Casey,
a random-
full disclosure, not my estate planning attorney. But my estate planning attorney goes, why 53? I go, well, about 6 months ago, we did a podcast. And people make their very best financial decisions at 53 years old. So that was reason 1. Reason 2 is if I pass away when my kids are 18, and 1/3 of the money has to sit there for 35 years, it's going to be virtually impossible to mess it up at 53. Like they're going to have to try to mess it up because remember, if there was $1 million, we got 35 years of growth on $1 million now. So I'm not letting them spend that money.
Jonas, I want to go sort of off topic, but it's something where I think there's a lot of people that they're afraid. We know now that there are fewer people, younger people having babies. They're getting married later in life. They're buying their first house. I just heard the average age of purchasing their first house now is at 42 years old.
It's up. It was 38 like 6 months ago.
I know. And people are pushing things off and pushing things back because of the negativity that they have seen since they started. I mean, for these people in their 40s, how many different market dips have they seen? How many apocalypse du jour? But it's something getting them so that when you do get them in the office, is say, hey, you know what? there's a way to mitigate all these things that you have.
People in their 40s.
Mm-hmm.
Yeah, they have a lot of wisdom. You look at they lived through the tech bubble burst, and then 2008 there was a mortgage crisis. Maybe they were affected on the east and west coast. Maybe they lost their home, and then so they've been through quite a bit. But the advantage that they have, and Roger kind of touched on this, all that wisdom. There's money backing that wisdom. They're in their 40s. They're in their peak earning years right now. And you mentioned it on another show, Doug, about catch-up provisions and catch-up contributions. And I love what Roger said earlier, that it's all about your savings rate. If you're in your 40s and you're making a decent income, if you have a better savings rate than your coworker, you will be more financially successful than your coworker when you both retire the same day 20 years later.
Yeah.
Think about that. One thing. That's all Roger said. One thing is the savings rate.
That's all that matters. And here's what's ironic. Your savings rate is not your 401k, like match, like those things aren't how you determine your savings rate. Like people think, well, I can only put 23,000 into my 401k. That's what I have to do. Well, if you're making 600,000, you only put 23,000 a year away, you're underprepared. Your savings rate is determined by the financial advisor that a Casey would do, or I would do, or Jonas would do. That's how you determine your savings rate. Not what some IRS guideline tells you can do.
Right. Well, you're talking about what is the maximum you can put into this plan type.
Right.
Not necessarily the maximum that we need to be actually setting aside.
Remember, we're privy to the information of what people need to do. Most people hear, well, if I put 6% away, my company gives me 3%. They believe inherently that is the savings rate that's going to make them successful. Because why wouldn't they tell me to put in more if I need to? They will not tell you to do that. You have to determine your own savings rate and figure out what that number is in concert with your goals and values 15, 20, 30, 40 years down the line and get it right.
There are a lot of people, though, Casey, that are leaving money on the table, though, because they're not maxing out their different accounts, whether it's, say, their 401k or 403b, and the match that goes along with them, let alone the other stuff we're talking about.
Right.
Billions
Well, and it also, I mean, it depends on the way that you're accessing that 401k or how you're putting money in there too. So one of the things, especially when it comes over to those 401ks, so kind of what you mentioned, I mean, there's billions of dollars that are left on the table every single year of people that aren't putting in enough money to meet your full match. I mean, it's not, I hear this term where it gets thrown out that that's free money. I don't like that. It's not free money. It's part of your compensation package. You're simply telling your employer, I will work for less than what you are willing to pay me. So reframe it that way, and then you realize you just inadvertently cut your own paycheck, and that maybe might be a little bit of a better motivator. But the other part of that too is that not all plan actually has what are called true-up provisions. And what a true-up provision is if you over-contribute or you put in too much money in the first part of the year, you hit that maximum that you were talking about, that $23,500 for the employee deferrals for 2025, Roger. If there's not a true-up provision and you hit that in June, well, you might be foregoing 6 months of match because you're not putting any money in the back part of that plan. Now, there are some plans that, again, this is very plan specific. I would say typically a lot of large employers that I've seen in this, they have a true-up provision saying, well, if you do that full contribution in the early part of the year, we'll come and true you up and we'll actually match it. But that is not something that is consistent across all plans. So stretching it over a full year or not stretching it over a full year might also be leaving money on the table, even though you've put in the full amount that you're willing to put in.
Jonas, talk to me a little bit, because we've been focusing so much on 401ks here. There are other things you want to make sure that you're working with as well to make sure you're maximizing contributions to your different retirement accounts, the IRAs and Roth IRAs.
Yeah, absolutely. And, I think that Roger hit the nail on the head. It's you're in your peak earning years. Don't let that guideline, one particular amount, get in your head. You need to actually save more than you possibly can. A couple of other things, Doug. You look at you really have to balance risk and growth in your portfolio. You're reaching a point to where This is a pivotal time, I think, in your 40s. And if you can be aggressive about eliminating debt, I love talking to 40-year-olds about making extra payments on their mortgage. That I really get excited about that, because if I can get them to do that, just the sheer amount of time that they have left on their mortgage is going to be eliminated by years, 3 to 5 to 7 years. And as this is kind of funny, guys, the mortgage companies don't really make it too easy for you to make extra payments.
No.
If you've ever tried that, it's depending on what mortgage company, it's not very good. And then the last thing I'll say, which I love spare tires, Doug.
Oh, big fan of spare
in your
tires.
40s, I just sent off a check for a new AC unit in the mail this morning. You have to have an emergency fund over and above. You have to have a second spare pile of cash, just in the event there might be an opportunity in the market. There might be an opportunity to buy a business. It could be something that you're going to change careers. Maybe you have 180 days of wages saved up, and you've always wanted to switch careers. That makes you more flexible, gives you a margin of safety to do what you want in your life. So there's a lot of different things you can do, a lot of exciting things you can do in your 40s.
Yeah, it's kind of interesting. You mentioned the career changing. And just, again, not obviously definitive by any stretch of the imagination, but I have heard for about every $10,000 of income, figure about a week off in terms of that job search. So just as a really quick rule of thumb, I mean, if you're talking, $150,000, $200,000 a year, I mean, you might be off for a couple of different months while you're looking for that replacement job.
Well, yeah, because you're probably holding out for management,
right?
Just like Cousin Eddie. Hold out for a management job. You said that, it was just said, I'm like, yeah.
Premier Investments and Wealth Management. We're talking with Jonas Everett, with Roger Abel and Casey Mushrush, and we're talking about retirement savings strategies in your 40s. Doesn't matter whether you're in your 40s, 50s, 30s, 60s. If you need professional advice, then the folks at Premier Investments and Wealth Management are the place to come. PremierIWM.com. Once on the website, click Get Started. Answer a few questions. They'll provide for you a one-page Premier Vision document. Helps you get a better understanding of whether you're prepared for retirement at whatever age you are. Get in touch with them at PremierIWM.com. Also, you can download the guide to Navigating the Road to Financial Freedom. Lots of good downloadable information. You can even make your appointment online. If you go through that Get Started, click there and do all that, they will reach out to you, schedule an appointment with you, sit down for no fee. They'll walk you through the one-page Premier Vision document and hand it to you at the end. You can use it however you'd like. Like to think that you'd be working with Premier Investments and Wealth Management by the time you're done with that. PremierIWM.com or call 800-383-6590. Roger Abel, let's go back to you here real quick. Jonas hit on something a little bit earlier. You talked about the importance and say, hey, I'd love to talk to people about paying a little bit extra on that mortgage. If you're in your 40s and you have the opportunity to start paying down some of the higher interest things you might have accumulated when you were a little younger, maybe spending a little less frugally than you are now, it's a really good time to do that.
In your 40s, you can put together a plan to get your debt paid off by the time you retire. And what a debt-free retirement really is, it's less risk. Debt is risk. It's no different than stock market investing. Debt is risk. What if I lose my job and now I can't pay my debt? It's a level of risk. And if people started to quantify their house payment, some people, they're 50, they take out a 30-year loan, right? So you're going to pay this till you're 80. Well, if you borrow $500,000, the principal, interest, and taxes on $500,000, close to $5,000. How much money does somebody have to have saved up to generate $5,000 of monthly income? Probably in the neighborhood of $1 million to $1.5 million extra just to generate that income.
Yeah.
So if you could pay that off, it's actually less money you have to have saved. I get the question all the time. Well, how do I compare to my peers? How am I doing? Well, it's irrelevant. It's only relevant to the amount of debt you have, the payments you have, and the lifestyle you live. It's only a relevant thing. So eliminating debt starts in your 40s. So if you're 46, You want to retire at 60, go find an amortization calculator, plug in how much you owe, what your interest rate is. How much do I have to pay over the next 14 years to get my mortgage knocked out? And if you start paying a little bit more over time, it's a heck of a lot easier than saying, man, I'm 59, I'm retiring next year. I need to come up with $200,000. It's like dollar cost averaging just into your mortgage.
Right.
Something you mentioned on there is the comment you just said about as far as the actual mortgage in and of itself being a measure of risk. Right, because when you take a look at, again, based off the numbers that you're running over on that side of trying to eliminate or reduce down that overall portfolio, like it doesn't really make a whole lot of sense to me. To somebody says, "Well, I want to hold on to this thing because of the tax benefits and all."
There's
that
no tax benefit.
Well, there's
You're
not.
paying-
I mean, we just had a piece of legislation that a standard deduction is it's over $30,000 for a married couple right now.
Do you know how hard it is for someone to itemize $30,000 with a $10,000 limit on the state and local tax, even if it's raised to 40? Go find me a person who's making
Right. Well, I mean, that's
$200,000 a year.
realistically, you're talking maybe over on the East Coast, maybe somewhere in Texas or something like that where property taxes are a little bit higher. Maybe it's relevant in that kind of a situation. But for the vast, vast majority of people, it's just not. I think it was like 87% of people, just in the last couple of years alone, 87% of people took the standard deduction. And we just made that permanent.
Well, here's what's ironic about the legislation. Now we're talking about the one big, beautiful bill.
Yeah.
But it's okay. But think about this. Well, that SALT deduction's only up to $400,000. After 400, it goes away. Well, how many people making 200,000 have a $30,000 property and state tax bill? Not very many.
Yeah.
Like, yeah, in California on 200, you could hit it. The vast majority don't have that problem, and most people in California are making a lot more than $200,000.
Right, but that also has
so
a
they
lot
don't
more to
get the
do
SALT. It's gone.
with the property rather than the income too.
Well,
right?
the income too. I mean, the incomes there are four
Yeah.
X.
That's why everybody on the coast and even in parts of Chicago and major metros, that they were the ones that were clamoring for the SALT deduction in order to be able to put it in there.
But at 400,000, is it really going to do most people any good?
No.
It's going to do a small percentage. It's not doing wealthy people any good. I know they want to tout that. Well, wealthy people got the how? They didn't get any benefit to this.
We're talking about retirement savings strategies in your 40s.
Digressed. Sorry.
We're going to turn a little bit. Casey, something I remember when I was in my 40s, maybe the thing that I was most concerned about as far as healthcare needs is pulling my hammy in advance of the softball game. That's the one thing I didn't want to do. What you're talking about now, I mean, it's some sophisticated stuff. Well, it can be sophisticated, but it's pretty simple.
So I mean, we take a look at future healthcare needs, right? You know, the 40s are a great time to start planning for that. You know, depending on the way your health insurance plan is set up, HSAs are possibly the best retirement planning account that are out there right now. You can get a triple tax. You know, there's a triple tax advantage with them. You can get a deduction when you put money in. You can pull it out tax-free if it's for medical expenses, you know, either now or in the future. You can also get tax deferral on the thing. So you can pull the money out after age 65 and just pay ordinary taxes on it like you would a traditional IRA. So they are one of the most powerful retirement planning vehicles and probably one of the very underutilized, I think. Now, that might be a function of the contribution limits. They're pretty limited in the amount that you can put in. It's like $8,300 for a married couple. You know, for 2025, but definitely taking a look at that as some sort of a future item is important as well. Now, kind of not even on this though. There may be, and this I think kind of gets into that healthcare range, is because right now, especially for people who are in the 40s, maybe even late 50s, you know, we have this term of the sandwich generation where we've got older people and then they've got younger kids that are still on their insurance and things like that. How's that impacting you? You know, making sure you understand what is that potential impact. You need to be, maybe it's that third spare tire, Jonas, of having that additional cash that's available to make sure that if something happens that's unexpected on the healthcare front, whether it's for you or somebody that you care about, and now you're, you know, maybe not legally, but morally you're on the hook that you need to be helping them out, that you can actually do so.
Question. What do you think the biggest healthcare expenses that people don't plan for removing long-term care from the equation?
Removing long-term care?
Yeah, like true healthcare expense, the one thing nobody thinks about that is going to go bad, they're not planning on it.
I would say meds.
I think it's teeth.
Oh, yeah.
Oh,
Teeth. You know what it costs to do a full month? So I have an individual who needs a full, like teeth are starting to rot.
Pull all of them, put dentures in.
40,000.
Whole thing. Yeah.
40,000.
It's
wow.
insane.
To do the bridge,
Yep,
to take
exactly.
the teeth out, to get dentures, $5,000. How many people are saying, "Hey, I likely need on the sideline $5,000 to $50,000 to take care of my teeth"?
Is
They
his
don't.
dentist Yukon Cornelius? Is he
No, dude, if you have
silver and gold teeth in?
trust me, no, it's not. Like,
No.
this stuff's to do
Yeah.
a bridge like $5,000.
I know.
It's
I've got
crazy.
somebody I know the exact same thing,
Yeah.
and it just blew them away, and they were just like, "I don't know what I'm going to do now," because that's not anything that they ever envisioned.
Didn't buy it. Well, number one, the dental plan you can buy doesn't cover
Right.
that
Yep.
much.
Yep.
Right.
Medicare doesn't cover it. So it's, in my opinion, it's like this giant hole out there
Yeah.
that nobody's thinking about. That's going to happen. Like, our teeth are not getting better.
Premier Investments and Wealth Management at premieriwm.com. It doesn't matter whether you're in your 40s and you're listening to this, but mom and dad or grandma or grandpa, even if you have people who are in or near this 40-year-old range, it's critical that they have professional involvement in their life with regard. They've got doctors, they've got attorneys, they've got houses of faith. Why are they not working with wealth advisors? premieriwm.com is the website to go. Have them click Get Started and then answer a few questions. They get a one-page Premier Vision document, one page, and they get to keep that after they sit down and talk things over with a financial advisor. And I think that they're going to benefit from it. So pass along this radio show, this YouTube show, pass along this link to them and say, you know what, I was thinking about your financial future today. Here's some really good ideas. And make sure that you help them understand that they don't need to sacrifice the possible because of the perfect. It's not going to be perfection every time. If you're worried about not having enough and you just don't want to start now, you're making a mistake. Get started, premieriwm.com. Call today, 800-383-6590. For Casey Mushrush, for Roger Abel, for Jonas Everett, I'm Doug Wagner. Thanks for watching. Thanks for listening.
The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities, regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.